We've been hearing a lot about crypto ETFs recently. Last month, BlackRock, the largest asset manager in the world, filed for a spot Bitcoin ETF. Other financial institutions like WisdomTree, Invesco, and Fidelity also proposed their own applications. But more than 2 years ago, your company, which is based in Canada, actually helped launch what you say was the world's first physically settled Bitcoin ETF. At the time, you called it a groundbreaking investment vehicle. Why did you think this was important back then? And what do you make of this recent push into crypto from financial institutions? What do you think that signifies?
We built the world's first Bitcoin spot ETFs with Purpose Investments a couple years ago because it's clear that the asset class is here to stay and people are looking for exposure points. A structured product like an ETF is more tax efficient. It abstracts away things like custody risk for the end user. And so for those who are institutions or retail investors who don't want to take on signing up on exchanges or figuring out how to custody the assets on their own, it's a far cleaner access point for those individuals. There was renewed interest in the space, certainly in the second half of 2020, as you saw Bitcoin go from just under $10,000 all the way up to in the mid 60,000 US range. And so we ended up with over $1 billion into those products. Alongside the Bitcoin ETF, we also launched with Purpose Investments an Ethereum ETF. And so, people are looking for access points. In the second half of 2020, there was renewed interest in the space following a prolonged bear market for a number of years. And I think as we move into the latter half of 2023 and 2024, you're seeing large US asset managers again recognize that the asset class is here to stay. They're going to be creating access points that their clients are going to want to purchase exposure through. And that's a good thing for the industry, and it's a good thing for the investors. It's good all around. Now the question is, when will the SEC be comfortable with bringing that type of a product to the US market?
Overall, has there been a lot of demand for your spot Bitcoin ETF and your Ethereum ETF since it was launched back in 2021?
Certainly at the outset of the ETF launches during a bull market, there was a lot of interest, a lot of money flowing into those two products. As things changed in the latter half of 2022, there was less buying and less intraday trading, but that's fine. These things ebb and flow, and crypto certainly moves in cycles. We're currently probably leaving the bear market and about to enter some type of bull, or at least sentiment is turning more positive. And so those products are on the shelf and they're there for when people are ready. Ether Capital, my company, is staking our own treasury. I think we're one of the only access points in the capital markets for staking exposure. And so again, we just need more of these type of products for investors to be able to access. We want them to be able to choose which access point is appropriate for their needs, what they're comfortable with tech-wise, and then they can go out and either sign up on an exchange and buy the assets direct. They can look for something that's tax efficient or something that takes care of the custody on their behalf with the right disclosure and the right type of trading activity, and then buy that way. And so whether this stuff happens in the next few months or it takes another year to go through, I don't think it really matters. If the SEC drags their heels a little bit for the time being, that's okay. Eventually, one of these ETFs is going to get through. And again, that's a great thing for the industry and the investors.
Overall, what do you think investor appetite is for structured products right now compared to holding the assets directly, especially amid the current regulatory environment?
I would say that investors may not be looking necessarily at structured products today. The people who are buying the assets direct are usually ones who are a little bit more tech comfortable. Maybe they're a bit more internet native. And so they're buying whether it's in bull markets or bear markets. Those people are following the industry on Twitter and deciding that they want exposure in their portfolios to the sector. The professional investors or retail investors who aren't following the space, who are more likely to buy a structured product, they may come at some point later. So I don't know if an ETF were to launch today in the US, if it would see billions of dollars of inflows on day one. But again, that's okay. It'll happen when the sentiment continues to shift positive. Where the sentiment exactly is at currently, I don't know, is that relevant? I think there's big catalysts on the horizon. When one of these ETFs gets approved, that'll be a very big deal. And the largest market in the world and one of the strongest crypto development communities is right here in the US. And in 2024, we have events like the Bitcoin halving, which is where the block reward, which happens every 10 minutes, this is new Bitcoin being created, that gets cut in half. And if you look historically at these halving events, which again take place every 4 years, they usually act as positive catalysts for price momentum to the upside. It may not happen the day of the Bitcoin halving, but they happen within a few months. Doesn't guarantee that it'll happen again, but it is something to look forward to. And as we start to see clarity around the regulation in the space, you've seen the EU put in place some new rules. Japan is leaning into the space, so is Hong Kong. And the US is going to sort itself out. And those are all positive things for the industry. And those who don't have exposure yet, who have been sitting on the sidelines, will feel more comfortable that the assets are here to stay. And they'll start to have more conviction and decide that it's time to have some exposure inside of their portfolios. So what happens in the short term is anyone's guess. But I think as we move to the second half of this year and move into 2024, there's a lot of things to be excited about in this industry.
So this week, we learned BlackRock refiled for its Bitcoin ETF after the SEC found flaws in its initial filing. So given your experience in the space, I know you touched on this, but what do you think will be the outcome? The SEC so far has not allowed a spot Bitcoin ETF to launch in the US. In fact, the agency is currently in a legal battle with Grayscale over whether the company will be allowed to convert its Grayscale Bitcoin Trust into an ETF. So what do you think will happen with BlackRock's application specifically?
My prediction will be that the SEC will continue to drag this out until they're comfortable or feel that it's ready to greenlight a spot ETF. Whether that happens in a few months or early next year, I'm not sure. But the pressure is on. If you were a government or a regulator, you should be in favor of ETFs because you know where the custody of the assets exist. When retail investors go and buy the assets on their own, it could happen on an unregulated platform. It could happen in a self-hosted wallet. It's harder to monitor the behavior versus saying, we understand that people want exposure to the price movement of these assets, and we'd rather them do that through a regulated product than through something that they can't monitor with as much ease. So there's a lot of reasons that government should lean into these ETFs, why regulators should be saying it's time. We understand that there have been filings for over a decade now. If you look at the Winklevoss brothers, they filed for an ETF where it could have been called a trust back then. That was 2013. So we've seen a number of filings come before the SEC. It was a far more nascent industry back then. There were a number of filings along the way in the 2017 and kind of 2018 era. And now we're here in 2023. You have $1 trillion worth of assets that are sitting in the industry. There's successful businesses. There's been businesses that have collapsed that weren't regulated. And so bringing more products to market that investors can have confidence in, that are appropriate, that are letting them invest direct in just the protocol assets versus equity in the companies, that's a very good thing. If you look at what's gone wrong in the last number of years, things that have truly gone to zero, it hasn't been the protocols. It hasn't been the exposure to Bitcoin or Ether. Sure, they've been volatile and they dropped a significant amount alongside the rest of the market, but it's the equity in the businesses that didn't survive. And so that's why I think getting more people to just be able to have exposure to Bitcoin and ETH is great. We're starting with Bitcoin ETFs in the US, and you would assume that once those are approved, we'll see people file for Ethereum ETFs and hopefully sometime soon staked ETH ETFs, which would give people the exposure to not just ETH, but the ability to generate yield of somewhere between 4 and 6%, depending on a number of factors on top of those holdings. So there's a lot of creativity in this space. There's a lot of excitement and new products that can be built. What we need is that first one through the gate that paves the way for all the others and more things to build.
It certainly will be interesting to see what happens. But switching gears, Ether has been trading above $1,900 recently. What do you think is driving the price of that cryptocurrency right now? Do you think this signal of confidence in crypto from Wall Street has anything to do with it?
I'm not sure if the rebound in the ETH price is specific to these ETFs, but we had the transition from proof of work to proof of stake in the fall of 2022. That was replacing Bitcoin style mining with the ability to validate transactions by just locking up your Ether. And so that means all the Ether holders out there are able to generate a yield of about 5%. Ether Capital has been staking over 35,000 of our own balance sheet, and that's a really exciting thing. And I think what you're seeing now is people who are looking at this space and saying, where's the signal amongst all this noise? And they're realizing that all these other layer one protocols, all this metaverse stuff and NFTs, something may come out of it long term, but the real two gem assets are Bitcoin and ETH. And so building a portfolio that's just exposure to Bitcoin, exposure to ETH, taking that ETH and staking it is a really good play for investors who have a low time preference. So as investors move from Bitcoin to what else is out in the space, the obvious one would be Ether. With over a $200 billion market cap, the ability to generate a 5% return on that, that's hard to ignore. And you're starting to see more people stake their ETH. The validation queue, the number of people who want to participate in validating and confirming transactions continues to grow every day. And that makes for a more robust network. It's going to make the network more resilient. And it means that more people want to participate in that specific ecosystem relative to the other layer ones. So we're getting more signal here, and we're decluttering all that noise, and that's a very good thing.
Expanding on that, Ethereum's staking ratio has been rising since the network's last update in April, the Chapella upgrade. According to data from Nansen, staked ETH surpassed 23 million last month. That represents about 20% of the nearly $230 billion supply of ETH. What do you make of this? And do you think Ethereum's staking ratio will continue to move higher?
I would expect the amount of ETH as a percentage to the circulating supply will continue to increase. When you look at websites like stakingrewards.com and you look at other networks that offer staking for their tokens, they're far above 20%. Now, I'm not sure if that's because there's nothing that exciting to do in those ecosystems or just people want to take what I would consider the risk-free rate. But I think more people are going to stake their ETH. For those who are holding long, they're not looking to trade the asset. They're not looking to sell it within a week or a month and say, I'm going to just have a low time preference. I'm going to hold ETH and I want to clip a 4 to 6% yield, and that's going to fluctuate. Then this is a great opportunity for them while helping secure the network. So whether the total circulating supply that gets staked ends up being 25% or 40%, it's kind of anyone's guess right now. I think as we move to the second half of the year, we'll have a better sense. And one thing that people can do to track this is look at the entry and exit queue. And what that means is there's so many people who are able to start validating or staking their ETH per day. And that queue has been very long. That queue is currently around 45 days. And for context, this was only 10 days a few months ago. So what that says is more people are wanting to lock up their ETH and stake. And the exit queue is only a few days, which tells you that not that many people are looking to withdraw their ETH. So they're bullish long term. Whether those are institutional investors or retail investors is it's difficult to say at this point, but we are seeing the trend of more participants in the Ethereum ecosystem looking to stake, and that will continue to grow for the foreseeable future.
What else are you paying attention to in the crypto space right now?
Clarity around stablecoins is something to watch. I am really excited. It's not an Ethereum specific thing, but to see how the US sorts out what registrations are going to look like for crypto trading platforms. We currently have the lawsuit between the SEC and Coinbase. And however that lands, I'm not sure. But what's important is that there's going to be clarity that comes from this. People in this space are looking to be good actors. They're looking to operate above board businesses. And the sooner that we can bring them that clarity and say, here are the rules and the expectations, that's great. We want these jobs here. We want these assets to be in the US. We don't want to send them to unregulated platforms overseas. I still think it's better for retail investors or those who aren't that tech savvy to be holding and trading these assets on a platform that can help them with the custody, that could help them with tax reporting and monitoring of which assets get listed and don't. And hopefully keep away some of the rug pull type of tokens, things that are higher risk, higher volatility, and more likely to go to zero. That's a good thing. And so the sooner that we can create clarity and guidelines, the better for everyone. That is something certainly to look forward to. And I think we're close. Whether it's another year away, I don't know, but we're not 5 years away. It's obvious to Congress that we need to bring this to the space. We need to put pressure on the regulators, not just to create their own rules, but to work with industry. It's a very nuanced space. It has its own crazy lexicon and terms, and it's evolving. And so it really requires the collaboration between industry and government and policymakers to figure out how this asset class is going to exist inside of this jurisdiction. We've spent a lot of time in Canada as part of the Web3 Council of Canada, which I'm the president of. We spend a lot of time just doing basic education. And it's not about pro, con, the asset and what the price is. It's trying to help them understand why these assets exist, what you can and can't do with the assets. Maybe we have to be creative around how we monitor the behavior of users on these networks, because it's a different technology. It's a different technology than our banking system. And so ensuring that the usage of the technology is on side, that it's not used for criminal activity or to evade sanctions, there's ways to do it. The ways may look different than we have in the traditional banking sector, but that's okay. There's technology and tools that people can use to bring that to this space. And so the more we can help the policymakers understand that there are different ways to do it, but we can still achieve the same objective, that brings comfort to them. And I think also trust with good players in the industry who want to operate above board and help them come to the right guidelines and guardrails and frameworks to say, here's how this industry should operate inside of these states and inside of this country.